Ever wondered how banks make money from loans and bonds? Today, we are going to embark on a fascinating journey to unravel the mystery behind bank loans and bonds. While you might have heard about these terms, their intricate workings can seem like a labyrinth. But fear not, as we'll simplify this financial jargon in a way that's as easy as pie. Let's start with bank loans. Essentially, when you borrow money from a bank, you're taking a bank loan. It could be for buying a house, starting a business, or even for your education. The bank plays the role of a lender, providing you with the necessary funds to fulfill your needs, and in return, you agree to pay back the loan with interest over a specified period of time. Now let's move on to bonds. Imagine you're lending money to a company or the government. In return, they promise to pay you back the principal amount along with interest at a predetermined date. That's essentially what a bond is. It's a type of debt where you're the lender and the company or government is the borrower. Bank loans and bonds are vital financial instruments. They are the lifeblood of the banking industry, driving its profitability. Banks earn a substantial portion of their income through the interest they charge on loans and the services they provide related to bonds. But how exactly does this happen? How do banks transform these loans and bonds into profit-making machines? Well, the mechanism is intriguing and involves a blend of smart financial strategies and a deep understanding of market dynamics. This journey of discovery is set to be an enlightening one, and we're just getting started. As we delve deeper into these topics in the upcoming scenes, we'll unveil the intricate workings of bank loans and bonds and how they contribute to the banking industry's profitability. So stick around if you're curious to know how these financial instruments work. Dive right into the world of bank loans. Think of a bank loan as a financial bridge. It's a service that banks provide to help individuals and businesses bridge the gap between their current financial situation and their future goals. Whether it's a young couple looking to purchase their first home or an entrepreneur starting a business, a bank loan can provide the necessary funds to make these dreams a reality. So how exactly does a bank loan work? Well, when you approach a bank for a loan, they assess your credit worthiness. This is done by examining your credit history, income, and overall financial health. Once the bank is confident that you can repay the loan, they set the terms of the loan agreement, which include the loan amount, the interest rate, and the repayment schedule. The interest rate is a crucial element in a loan. It's the cost of borrowing, expressed as a percentage of the loan amount, that you'll need to pay back in addition to the principal amount. Depending on the type of loan and your creditworthiness, this rate can be fixed or variable. A fixed rate stays the same throughout the life of the loan, whereas a variable rate can change based on market conditions. Now, you might be wondering, why would banks go through all this trouble to lend money? Well, that's how they make a profit. The interest you pay on your loan is essentially the bank's income. And the riskier the loan, the higher the interest rate, hence the more profit for the bank. But remember, while bank loans can be a great tool to help you achieve your financial goals, it's essential to borrow responsibly. Ensure that you can comfortably afford the repayments and never borrow more than you need. Now that you know how bank loans work, let's move on to bonds. Now let's shift gears and talk about bonds. Bonds, just like bank loans, are a type of debt, but in this case the roles are reversed. Instead of you borrowing from the bank, or any other institution for that matter, borrows from you. Picture this: you're lending your hard-earned money to the bank, and in return, the bank promises to pay you back with interest at a predetermined date in the future. That's the basic idea behind bonds. So how exactly do banks issue bonds? Well, it's a well-orchestrated process. The bank, often referred to as the issuer, creates the bond with specific terms. These terms include the total amount of the bond, the interest rate, also known as the coupon rate, and the maturity date, which is when the bank has to pay you back your initial investment plus the agreed-upon interest. Once the bond is created, it's open for purchase. Now anyone, and by anyone I mean individuals, companies, and even other banks, can buy these bonds. The money you pay to buy the bond goes straight to the bank, and voila, they've successfully borrowed money from you. Now you might be wondering, what's in it for the bank? Well, the answer is simple: revenue. The money raised from issuing bonds can be used by the bank in various ways. They might lend it out to others at higher interest rates, invest it, or use it to improve their services. And don't worry, while the bank is making use of your money, your investment is growing too, thanks to the interest accumulating over time. So in essence, bonds are a win-win. The bank gets the funds it needs, and you, the bondholder, get a return on your investment. It's a relationship built on trust and mutual benefit. With a good hold on bonds, it's time to see how these two concepts intertwine. So how do banks profit from loans and bonds? It's an intriguing question, isn't it? Well, let's start by looking at bank loans. When you borrow money from a bank, you pay an interest rate on the loan. This interest is essentially a fee you pay for the privilege of borrowing, and it's a primary way banks make money from loans. The bank lends out money it has on deposit, then charges interest that's higher than what it pays to its depositors. This difference, known as the spread, is where the bank's profit comes from. Now, on to bonds. When a bank buys a bond, it's essentially lending money to the entity that issued the bond, like a government or a corporation. In return, the issuer promises to pay the bank a fixed interest rate over a set period of time, as well as repay the original amount known as the principal once the bond matures. The bank profits from the interest payments it receives. But here's the twist. Banks don't just hold on to these bonds. They often sell them to other investors, sometimes for more than they paid. This selling at a premium is another way banks can make money from bonds. Of course, both loans and bonds come with risks. Borrowers might default on their loans, or bond issuers might not be able to make their interest payments. That's why banks carefully assess the risk before lending money or buying bonds. They use sophisticated models to predict the likelihood of default and adjust their interest rates accordingly to compensate for the risk. It's a delicate balance of risk and reward, but banks have become experts at managing it. By diversifying their portfolio with a mix of loans and bonds, they can spread the risk and maximize their profits. So, there you have it. A quick tour through the financial mechanics of how banks make money from loans and bonds. It's a complex system, but at its heart, it's about lending money and charging interest and buying and selling bonds at the right times. Banks have truly mastered the art of making money from loans and bonds, and now you're a little more informed about how they do it. Let's summarize what we've learned about bank loans and bonds. In our journey today, we've delved into the intricate world of bank loans and bonds. It's fascinating, isn't it? How something as ubiquitous as a bank has such complex operations. But don't fret if it all seems a bit much. Let's break it down again. Bank loans, remember, are essentially a contract between you, the borrower, and the bank. You borrow a certain sum of money and agree to pay it back over a set period of time with interest. The interest is the cost of borrowing, and it's how banks make a profit from loans. Loans can be used for a multitude of purposes, from buying a car or a house to starting a business or funding education. On the other hand, we have bonds. Now, bonds are kind of like IOUs. When an entity, say a corporation or a government, needs to raise funds, they issue bonds. As the buyer, you're lending money to the issuer in exchange for periodic interest payments and the return of the bond's face value at maturity. So, you're essentially the bank in this scenario, lending out your money and earning interest in return. But how do banks fit into the bond scenario? Well, banks can buy and sell bonds just like any other investor. They can also act as intermediaries, helping to bring bond issuers and buyers together. Both loans and bonds are crucial tools in the financial world. They fuel economic activity, help individuals and businesses reach their goals, and of course, keep the wheels of the banking industry turning. So next time you walk into a bank or even just pass by one, remember that there's a lot more going on behind those doors than just safekeeping your hard-earned money. It's a world of lending, borrowing, interest, and returns. Next time you think of a bank, remember they're not just about storing money, but also about making it.